All right, I'll just give a few moments for everyone to get settled. All right, well, hello and welcome everyone to the Auto FinTech Lending Panel hosted by the Canadian Lenders Association. I'm pleased to welcome our panelists today. We have Ilya Troikansky, President at Axis Auto Finance, Tyler Thelman, VP Consumer Lending at Canada Drives, Jason Appell, Executive Vice President and Chief Risk Officer at GoEasy, Rosa Hoffman, CEO at DecisionIt, and last but not least, Amir Tajkarami, CEO at Lexop. Amir, as our moderator today, will take us through a panel discussion, and then we will be accepting questions live. So please remember, you can submit your questions at any time throughout the discussion, and hopefully we'll have time to get to them at the end. And as always, this panel is being recorded and will be emailed out to you all afterwards. So without further ado, I'll hand it over to you, Amir, to get things started.
Awesome. Thank you, Danielle. Thank you for everyone for being here. Thank you for your time. I appreciate the panelists, the experts who are here with me today. What I wanted to do is just take a few moments to introduce myself, and then you can take a few moments to talk about your story. And then we'll dig into some of the questions that we wanted to cover today regarding auto finance, fintech, and the elephant in the room, COVID, see how that affected business and so on. And obviously at the end of it, we will cover some questions. We'll go over to the chat and you can raise your hand in between if there's anything extremely urgent that you absolutely have to cover. We can address that as also. So quickly, my name is Amir. I'm the CEO and co-founder of Lexop. In a previous life, I used to be a banking lawyer for about 8 years, so I apologize for that. Nobody's perfect. And I did do some auto finance for about 8 months. So it kind of comes close to heart. And then ultimately we started Lexop, which is a Montreal-based fintech. And our software is a collection software that helps companies such as auto lenders help their past due customers pay their bills through technology, through flexibility, and through a more humane approach to collections. But that was me. That was my pitch. There's people much more interesting than me today. So I'll leave it. Maybe Rosa, you want to start it?
Of course.
Of course.
I'm Rosa Hoffman. I'm the CEO of Decisioning It, or Decisioning IT. What we do is we use AI to dynamically match consumers with the appropriate lenders in the automotive space. I've been in auto for over 15 years, to be honest. I would say I've been in automotive all my life, with a little time where I did some work with Rogers Media, and I enjoyed that too. So I've worked in this industry. I know it quite well. My co-founder and the president, Andre Hobbs, he actually owns 4 dealerships himself. And so he understood the need for a product like Lucy to come into market. And that's where we are right now. So I pass it on.
Awesome. Thanks for being here. Who else would like to take the lead? Tyler, maybe?
Go. Yeah, no,
or
sure.
Ilya, go ahead.
Absolutely.
Go ahead, Ilya.
So Ilya Troikansky, I'm the founder and president of Axis Auto Finance. Axis Auto Finance is a true non-prime, subprime lender. We operate coast to coast in Canada. We offer entire product spectrum, so from kind of B credit to deep D credit. And we've been doing this for 8 years now. Have grown from sort of a operation based on 1 dealership and 4 employees to now coast to coast, and
Wow.
$150 million book. So it's been quite a journey for sure, but we always look forward to the next chapter, and that next chapter is always achieved by technology. We always believe that. So glad to be here, and thanks for having me.
Awesome. Thank you, Ilya. Tyler?
Hey guys, I'm Tyler. Thanks to Canadian Lenders for putting this on and having me. This is great. I'm the VP of Consumer Lending for Canada Drives. I've been with Canada Drives for nearly 7 years now. We've evolved a lot during this time. I think there was about 5 or 6 people when I joined, and there's about 400 now. Canada Drives is the only 100% online real-time car shopping experience in Canada. So right now, if you're in BC, which is our launch market, you can visit our website, browse inventory, select a vehicle, get financing, and receive actual physical delivery of that vehicle on the same day. So that's what we're doing. And obviously the auto finance portion of that is quite significant. And yeah, I'm excited to join today. Thanks.
Awesome. Jason.
Yep, I guess I'm last. I'm Jason Appell. I'm the Executive Vice President and Chief Risk Officer of GoEasy Limited. I've been with the firm just over 8.5 years. GoEasy is brand spanking new to auto finance. We announced our intention to get into the market later this quarter, which we still intend to do, fingers crossed. But if you've been following the news, we are also now an automotive lender by virtue of our acquisition of LendCare, which we announced last week. So really excited actually to be part of this panel and look forward to getting insights and feedback from the co-panelists here. So thank you for allowing me to be part of it.
Awesome. Very exciting. We can cover many subjects with all four of you today. And the first one is actually a blast from the past. I wanted to, we go back a little bit and compare, right? So can you describe, and anyone can take it away, no preferences. Can you describe your business 5 years ago, 10 years ago, versus how it is operated today? And how has technology or fintech, but I say technology can be just any type of betterment, has transformed it today? So kind of like a previous look and now a further look down the line. Love to get that aspect. Anybody who wants to take it, it's yours.
I can start. I mean, our business has changed significantly over the last 5 to 10 years. We started in 2010. And anyone who's familiar with our business or we've worked with before, we've primarily started as a service with dealerships. So B2B offering. We still do a lot of that today and have fantastic dealer relations across the country. But over that period of time, we saw a lot of opportunity in direct to consumer markets. So we started our direct to consumer offering actually on the lending business side, which eventually became our brand Spring Financial, which is a separate business focused on consumer lending. But on the auto finance side, like I said, we've in the last year we've launched 100% online real-time car shopping, and we're seeing some really promising results. And I think it's just it's over the last 10 years we've seen a huge shift in customers wanting to do things online, and even further accelerated in the last 12 months through the pandemic. And so I think that, yeah, our business has shifted a lot to focus directly on consumers. And one thing we're noticing in Canada is there's not a Canada-wide nationally recognized either auto finance brand or even a retail brand for buying cars. The US has some things like this, like CarMax, or some very large shopping centers for vehicles. The Canadian market is very fragmented, I would say, on the retail side as well as on the financing side. And so I think we see that as a pretty big opportunity.
Excellent. Big shift. Ilya?
Sure. I mean, I think I agree with some of what Tyler said. Ultimately, what technology does is makes a business more efficient, and its speed, it's the amount of information you can process, it's all of the above. To give you some examples, if you look at 5 years ago, today our credit analysts can process 4 times more applications per hour than they did 5 years ago. Our collections department, we need 50% less collectors to service the same amount of volume. So all of that is technology. It's really on the front end as well as the back end. This has transformed the way we do business, and it has allowed us to grow. I can't imagine being able to grow without having these technology platforms in place, because then it's just throwing bodies at it. It's adding headcount, and we all know how expensive and management, extensive that is. So ultimately, we've seen a lot of technology innovation come into the market in the last 5 to 10 years. I think a lot of it is here to stay. Some initiatives might not be, but that's just technology evolution and sort of Darwinism in that space for sure. But you have to embrace it. You have to look at various ways that these technology innovations can help your business and implement whatever makes sense.
Awesome. So both of you, a lot of back office innovation. I have another question that came to mind about that. I'll jump into it in a few seconds. But maybe Jason, you wanted to add something to that?
Yeah, a couple of things. I mean, again, just more generally, and even if you go back 5 years, never mind 10 years, 10 years, at least in our business, we derived the vast majority of our business was branch-based lending. Online lending was really just in its infancy. And I certainly won't speak for the other panelists, but in our business, more than half of all of our lending is done online, or at least it starts online. So just the simple proliferation of online origination through technology, through engagement has been a sea change. So that's one area. I think a second area is just the accumulation and the wealth of data that's become available. So if you just think about that from two dynamics, Ilya talked about one, servicing. I would agree with him, and I would add, it's just simply credit adjudication sophistication. The kind of data that we can now integrate and build into our models to assess risk isn't what we were using 5 or even 10 years ago. We weren't relying primarily on just basic bureau information, maybe a score, maybe not a score. Maybe we had a few other elements in the scorecard. Today, some of the sophistication that's out there goes quite beyond that and brings in data from multiple sources, not just the credit bureaus anymore. And that's been a sea change when you can now identify pockets of customers that your competitors or lenders simply can't go after. So I think that's a big one. And I think the other thing that we've been a net benefactor of, and I think other organizations will follow, is with scale comes benefits of financing, access to cheaper and lower forms of capital, which allows businesses like Access and like ourselves grow. I mean, one of the ways in which we can grow our business is we can get access to cheaper and cheaper forms of financing, which means we can reinvest that financing back into growing our lending books. So that's not been a fintech innovation, but it's enabled fintech companies, or at least companies that have done a lot of their lending online, where you get scale. You can go out there and start to fund your business operations through cheaper and cheaper forms of debt. And that does allow those businesses to grow and expand in ways that they wouldn't have been able to do before. So those are a few trends that I see are very different now, at least in our business, that weren't nearly as present 10 or even 5 years ago.
Very interesting. And I mean, we do mention innovation in terms of underwriting, innovation in terms of back office. Have you guys noticed and change in consumer habits in the way that their appetite for technology and the way they relate to auto finance now? Have you noticed any change in terms of the end users, as I call it? Anyone?
Yeah, we have for sure. I mean, just to sort of maybe stick with the servicing side of things for now. Very simple things. People don't want to speak on the phone. They want to use text. They want to use email. They want to use chats, right? And it has implications both from a psychological perspective. We're in the subprime auto business. A lot of our conversations with our customers are not the most pleasant ones, you can imagine. So a lot of them are just easier to have over a medium that doesn't necessarily where you don't hear the other person speak. So certainly that's part of it. And then on the front end as well, I mean, as to Jason's point, people want to paint a full picture. The consumer wants to get the best rate possible, and therefore they're willing to share and to give us access to alternative sources of data that can help us make better decisions. So absolutely, the consumer behavior has changed for sure.
Yeah, I definitely agree with that. And I think most consumers are now so engaged with online retailing tools. They want to start and finish everything online. Where I feel the finance element is lacking is that's really the only spot where consumers don't get to completely finish the transaction. But I would say as an end user, that would be the biggest change. And I think COVID brought that on very strongly. Everybody had to shift businesses, consumers, we all had to work really fast and really quick to figure out how are we going to keep doing business, as we hear all the time, with the new normal, ways of doing business. So I think digital is major, and I think digital is the way we're going to stay. And I think, online transparency to consumers is what consumers want and will eventually have.
Perfect. And you created a great tangent regarding COVID, and it is the elephant in the room. So I wanted to ask, how has it affected your go-to-market, or how has COVID, the pandemic, changed the way you manage your auto finance as general?
Yeah.
What do you think of?
Honestly, on our end, it helped us. We're supporting an area. I mean, we do support prime consumers as well, but we do have a high specialty focus on the non-prime space. And once COVID hit, I think a lot of people knew and felt that pain that was coming on, and we ended up really pivoting and creating a second solution right away, so that we were able to support dealers with the online digital retailing side. So no longer just a software for your dealership, but also for the consumer side. So for us, I felt that it helped us. It made us move faster, and it gave us a lot more to go with. I think on a retail dealership side, I think we all internally went through a lot of fears of how do we do this. But once you get past that and you see the support you have in all of these, lenders and third-party companies that were working really hard to come up with solutions, we've all made it through, right? Like here in Ontario, we're on our third lockdown, and it's a piece of cake. We've gone through it.
Yeah, been there, done that. Is that it?
Yeah, exactly.
I think COVID has really accelerated. I mean, we always thought direct to consumer in an e-commerce environment was where we wanted to go. It's sped it up, and it's really compelling when you look at automotive is the largest retail segment in Canada, and by far like one of the most under adopted e-commerce segments. And so I think e-commerce adoption is like 1%. And so when you see that, there's a lot of opportunity there. And your previous question, I think customers are expecting to do more and more online now. They don't want to have to do something else. And so they want to be able to share data online, access, what is our offer? How can I do this from the comfort of my own home?
Yeah, I agree. It's interesting because I think it was Chase Bank that did a study, and it showed that in the 1 month in April 2020, the number of consumers doing transactions online jumped as much as in the last 10 years before. So it just shows you how fast COVID forced all of us to, and obviously the consumers to jump into that e-commerce space and do things online. And I think I agree with Tyler 100%. I mean, if we look at Carvana, we look at Vroom in the States, these are companies that their biggest problem is the lack of inventory, because they've got too many consumers that want to buy autos or cars that they just can't service. So at the end of the day, I think COVID forced all of us to innovate, to Rosa's point, go and accept digital documents, use DocuSign and whatever else, whatever other tools exist to be able to continue underwriting, because dealerships had to adopt as well. And, if they can't take walk-ins, then they need to buy leads and underwrite these people and, drive the whole process digitally. So it's been a huge change. And I think a lot of the changes that we've seen in the last year are here to stay, because frankly, that's the better way to do business.
Absolutely. I like it. Jason, anything about the elephant in the room?
No, I think you hit it. I mean, I remember last March, I distinctly remember we were about to pilot a year ago in March, we use eSign, which is sort of like DocuSign, just a different company. We were going to do an eSign pilot in a region in Canada to see what would happen if we took our customers through an end-to-end transaction and did it all digitally. And at that time, I remember I was extremely nervous about what's going to happen with fraud, what's going to happen with consumer adoption. Are we ready for this? Are we going to see an increase in sales or a decrease in sales? What will happen with conversion? And then literally a week later, we turned it on for the entire company. because
Yeah.
our branches they weren't shuttered, but as most of us experienced last March, there was a significant decrease in demand amongst all segments of the market, not just in non-prime, but also in prime. And therefore, God forbid, we didn't want to lose writing any business. We certainly knew our business was going to slow down, but we turned it on and we haven't looked back. We haven't turned it off, obviously, because we're still in a lockdown in many regions, but we haven't necessarily thought it was the big, huge risk that we thought it would be, at least from a security point of view. It remains to be seen if it's the right way to engage customers in a fulsome way, but at least from our experience to date, and it's just one lender, it certainly hasn't taken away from our ability to do business. And in some cases, it's attracted us to customers who probably would not have been wanting to go into a branch, especially if they were physically removed or distant or couldn't get to it. And now we've removed that barrier. So what we all thought, or at least what I thought was going to be a big risk for us to take, turned out to be a nothing burger. It really wasn't all that bad. And now it's around, okay, how do you then take that same mentality and lever it into other parts of your business where maybe those preconceived notions that we were prepared to test through anyway, well, maybe you don't necessarily have to slowly peel the Band-Aid. Maybe you can actually rip it off and not kill your business at the same time. Now, I'm not here to advocate we do that across everything, but eSign, at least as one small example of this digital transformation that's going on, proved that it really wasn't all that concerning if all of your other processes were still as robust. So it's amazing what adverse conditions can sometimes force upon your business. And I'd say we learned something. We learned something really interesting.
Absolutely. And we witnessed it too. I mean, in terms of, I call it the year of tech adoption. We're in the digital collection space, and all of a sudden we did more in 1 month than we had done over 2 years, just in terms of because it crystallized the value proposition of tech. All of a sudden you had no choice. And when you have no choice, you move a lot faster, right? Because it's a lack of, there's this inertia that you're bound to, that it can only be liberated through technology or through innovation. It doesn't have to be always tech. There's 2 questions here that I like. They're from the attendees. They're stemming from the same subject, which is the financial crisis that happened in 2008, right? So, and my question for the panel is, 1, what kind of shift did you see coming from that financial meltdown? And 2, is there a certain guard up position that you're taking in apprehension of the next financial crisis? So aspect number 1 of the questions is, how did it shift the auto lending space? And number 2, do you have a guard up approach or not for the apprehension of another crisis that's coming? And I could leave that to anyone who would like to take over these two questions.
I'm happy to start. I mean, we're talking about the Canadian market here, right? So what happened after the 2008-2009 crisis was a lot of the lenders left the market altogether. So all the US guys have exited, and there was consolidation between the Canadian lenders as well. I mean, obviously, we all know the 2 big banks in the space are Scotia and TD, and certainly they made credit adjustments that changed their position in the space as well. And what this resulted in was a huge opportunity for somebody who was willing to take the risk, for somebody who really stepped up and was still willing to underwrite in that environment. I do believe that the situation is very different today. I think what is sort of the biggest difference is that the government today is supporting the consumers that have been affected by this crisis, by the COVID crisis. And this is evident in, really the delinquency numbers across the board. I look at Goeasy, I look at Access, and a lot of the other lenders. We can see that. But I think, to your question, Amir, about being guarded, at some point, there's going to be a cliff. At some point, there's going to be, I don't know, I don't want to call it a reckoning, but certainly I don't think that the positive sort of developments in terms of delinquency we can observe today will last. I don't think that's realistic. I don't think that truly reflects the nature of our business. So, maybe it's not being guarded, but being prepared is the better way to put it, because I think ultimately this is not over. The economic impact of this COVID crisis, I don't think we've seen even the top of the iceberg yet. It will create difficult conditions for years to come. And frankly, in our opinion here at Access, when we look at the market, we think that the subprime segment of the market will only grow. The consumer in Canada was over-leveraged before this. We all know this. The banks are always careful. They're even more careful now. So that audience or the target market for companies like Access, like GoEasy as well, that market in terms of people, consumers in it will only grow, which will create a challenge and opportunity. I mean, the opportunity is obviously you get more customers to underwrite. The challenge is how do you pick the right customers in that segment. So yeah, we're in for a couple of really interesting years. I think there'll be golden years for subprime like there were after the last crisis, but obviously you have to be prepared for how they're going to play out.
I remember going through 2008 and 2009 and working for a GM dealer at that time. And, when we got the news that we were staying open, it was the biggest relief because at that time they were just cutting stores left, right, and center. So, I mean, to your point, of course, it makes sense that lenders were leaving. The US guys were just, I don't know. I mean, I remember Wells Fargo. That was a pretty big, it was a deep subprime lender at that time. So you weren't seeing a lot of business there. So it would make sense for them to leave. But, and I 100% agree that the future is going to be interesting. We're going to see a really big increase on the non-prime space. And I think there's going to be a new education of non-prime consumers. I think as auto fintech professionals have to also express that message out there that the narrative behind what is a subprime customer, what is a non-prime customer. I think there's just always this, this feeling or this thought of what that customer might look like or what they might, be buying, how much money they may or may not have. When the fact is, I mean, you could be a non-prime because you missed, 2 payments and maybe you were sick, maybe you were in the hospital. We don't really know. So I think that's going to shift. I think there's going to be a lot more compassion when we're financing these people and looking more into not just a credit score, but their story. And I really would love to see that change. And that's what we're trying to help with too.
Fantastic. Absolutely. And regarding any comments, Tyler or Jason, regarding the learnings of the meltdown, financial meltdown 2008?
I don't have a whole lot to add. I think I agree with Ilya. It's the government involvement has been extraordinary and be very, very interesting to see, if a similar or not, the next time we run into a recession, I feel a precedent has been set. So I'm curious to see how this plays out in the long run.
I remember 2008 like it was yesterday. The gray hair kind of justifies it. I was at Citigroup. And I was head of analytics on the Canadian and some of the U.S. credit card portfolios. And in the span of 7 months, we saw and we were at that point more of a near prime, second, third card and wallet with about a $4.5 billion book. In the span of 6 to 7 months, we saw our loss rate go from about 4 net charge-off, 4.25 to 12. Now, part of what drove that was the fact that we weren't originating much, people weren't spending as much. So it was somewhat denominator accelerated, but it tripled in under a year. And if you look at what's happened in the current crisis, I don't think any of us saw or would have foreseen at the time that it first dropped that we thought the government would come up with $350 billion of aid in an effort to prop up the Canadian consumer and get them to save money when they hadn't been doing it for 20 years. I don't think any of us were that smart to expect that the government would come and bail everybody out. I think the bigger interesting question is, are they going to do it again when the cause of the financial crisis of the next one isn't going to be a global pandemic that has to do with personal health and well-being? It might be because institutions get greedy. It might be because we have runaway inflation. I could come up with a million scenarios. And by right, every other recession I think that I and probably others on this call have lived through, they're not good for lending. They're generally bad for lending, or at least for the most part, they're bad for lending. And the only way that they're good is that usually coming out of these events, you see consolidation, which you've seen a bit in this last couple of months. And you see an opportunity for some players to get more aggressive and steal share from those who are not willing to be as a little bit more risky. But I think if I think about the market that we compete in, this non-prime market, it's got 9 million consumers. They hold just under $200 billion Canadian of consumer credit. With the exception of 2020, that market grows annually about 1 to 2 to 3% a year organically. It's a healthy market. You know, it does go in ebbs and flows, and it's here to stay. That market's not shrinking, to Rosa's part, it's getting bigger. And the needs of that consumer group, I think, are going to start to dictate terms in a way perhaps that the prime consumer has long since been dictating terms to the Canadian banks of this world. So I think as lenders in that space, we're in for some change. And because that group, I mean, we're all disparate in a very large market where none of us has a dominating share, except for the fact that we've got 9 million consumers that all sort of share the same credit profile, but they don't act as a unique class. They act very disparately, and hence we go after them very disparately. So as we think about where things are going and how to prepare for the next event, I think about it both in terms of how to reach out to this customer group and try and get them in different ways. And as far as the next crisis is concerned, I would be amazed if the government, A, can afford to bail us out again. And I guess that's really a question of whether or not we want to write the checks ourselves, because we're going to be the ones to pay for it. And then the second thing is whether or not we feel that, you know, 12 years on or 13 years on from 2008, are we better equipped to spot these trends in our portfolio? And do we have better technology and processes to react quickly or more quickly? And to that, I would say yes, because I would say even if the government didn't bail us out or the Canadian consumer out, I have a feeling that we would have been better managing this crisis than we would have in 2008, just because we got better, smarter, more data, more capability, better technology. But we really won't know how good we are until the next true recession comes around and we don't have the benefit of a bit of a golden parachute from the government.
Absolutely. And there is also this black sheep, this recession, this pandemic. We saw it, like collection rates actually during the months that people got checks, government checks, people were paying very well. I don't know, Ilya, if you noticed, I mean, this was an anomaly. I mean, the payments were actually right on time. We saw that payments, especially for non-prime consumers, they increased. So it was kind of like this fake bubble that was created within this pandemic where people are actually paying on time. And now that the PCU checks are stopping and it's all unemployment is also coming to an end, there's this massive backlog of receivables that's coming. And it's interesting to say that you all actually covered access to data by looking at the story Rosa mentioned. And speaking of that, knowing that you have to analyze it a little bit better and reach out in a more intelligent way, what is the biggest challenge you're currently facing? It could be very different, but you're currently facing in terms of access to data, right? We have questions here from the attendees. 3 of them touch the non-traditional data sources, right? And they'd like to know more, what do you collect? What do you look at? And what would you like to have access to that you don't have access now? I'd like to have your opinion on this. Rosa, maybe on this one?
Okay. I think for us, we're really able to see what we need to see, you know, through TransUnion, Equifax, through the consumer's personal data and information that they share with us through communication. What we find to be a bit more struggling at times is the partnerships that you need to build in order to make this a seamless process in the dealership. So partnering up with, let's say, some of the DMS companies that are very close shut and it's like, we're not letting you in because it doesn't really benefit the dealership at the end of the day. There are other processes. For us personally, it's within the F&I office. That's what we're trying to support. So creating those proper alignments that help us, again, support the dealer and provide the customer the information is important. So yeah, it's teaming up with the right partners. That's where I find can be very challenging, because if they're unwilling to be part of what you're doing, then you have so much more work to do.
Right. Absolutely.
Jason, yeah, what I would say,
Ilya?
Data. I mean, to be honest, the biggest challenge is just the willingness to go out and get it. I think, honestly, if lenders are not willing to do that because of their internal, non-willingness to do it, it's a huge mistake. And a ton of data is available, and it can be accessed in various ways, and it can be bought or collected And then it just comes down to interpreting it and analyzing it. And we at Access, we're huge proponents of alternative data. We've never relied, and I don't mean to be disrespectful to FICO, but we've never relied on the credit score as an underwriting criteria. We look way beyond that. And, you know, it's one of those things that you have to do in this business, because otherwise you like everyone else, right? Like you don't have any competitive advantages. So we use a ton of alternative data. We get it from anywhere we can, starting with technology tools like, you know, like the Flinksys of the world, like, you know, access to customers' bank accounts, employment data, really anything that we can get our hands on that can be used as a tool to predict the, you know, consumer behavior and outcome of a loan. So I think there are a number of fintech startups out there that offer alternative scoring services, and some of them I'm sure are a lot smarter than anyone that you know, is working at this inside the company. So I think there's an opportunity there to partner with people, as Rosa said, and, you know, see that if they can offer a better mousetrap, you know, obviously it has to work for your own book, for your funders, for your processes. But yeah, as I said, the only reason people don't get alternative data is because they don't want to.
Okay, good, well said.
I think
Jason,
from a car buying perspective, people are really looking for, you know, especially with the e-commerce transition, and especially if they're financing a vehicle, they're looking for more data transparency throughout their process. So one example that we're finding is, you know, a prospective auto finance customer, they want to shop for inventory based on payment size. And to them, that might be a very simple request. It's like, hey, just show me the cars and what my payments would be. But, you know, for anyone who understands the auto industry, there's so many different pieces involved in that, like their credit profile, the car that they want to buy, if they're trading in a vehicle, there's so many data points, and like Rosa's point, there's lots of different people that you would need to integrate in order to provide accurate data to a customer and saying, hey, sort the inventory by payment, right? I mean, one thing that we've done is we've provided an instant trade-in value tool on our site so that every single customer has an actionable value for their car based on our own algorithm. But I still think we have a lot of work to do to put together the full picture on, hey, this is exactly what your payment size would be on this car, and shop to the next car or the next car and be able to see their payments. And I think integrating with more banks, understanding, you know, different approval models and things like that are going to be helpful along the way.
Yeah, I agree with Tyler. I'd like more data, the better. I'd say, you know, to answer some of the questions that were raised on the panel, a couple of us have mentioned banking data. We're a big believer in that. We built credit models with it. It takes time, but we believe it's actually worth the effort, but it is an investment, whether you do it in-house or you source it outside. But if we talk about auto, I mean, I've seen some of this in the States. I don't know how effective it's been because it hasn't been done here yet. TransUnion was active in the US a number of years ago, but driving behavior data, insurance-related data, well, we can't touch any of that. But if customers were willing to give that up in exchange for information that we as lenders could provide, maybe it's a slightly better rate, maybe it's a more favorable term, maybe it's some type of enhanced program. I mean, that's where you can begin to incorporate additional information that either may or may not be predictive or indicative of their likelihood to repay or borrow with you again. And it's part of the risk you take anytime you want to ingest new data. But in no disrespect to my colleagues at either Equifax or TransUnion, but there's only so many ways I can skin a credit bureau, right? And we've skinned it. And I'm not saying we're done, but we've skinned it so many times, we got lots of skin. And we need more robust data sources that we can counterweight, because as was pointed out, I think by one individual who queried the panel, is there are other predictive indicators. We just don't know how they react in the grand scheme of things. And to build on Tyler's point, you know, those who can build a more fulsome picture of their customer, whether it's from a credit or a borrowing perspective, are going to win the game at the end of the day. And I'm not suggesting that it only means having to go into credit. It also means understanding their mindset, how they want to be engaged, how they want to be spoken to, which channels of communication make sense. And, you know, I think the companies that have done very well are those that have have added these sort of nuanced / proprietary connections for new data sources, or they've created spins on interesting data sources in an effort to draw customers in and play more of this give to get, because I think that's how you're going to win it at the end of the day is, unless you want to go through the very lengthy and laborious process of, buying a bunch of data, retroactively seeing if it makes sense, or even buying it, testing it, and then maybe a year or two putting it in, there needs to be a faster, more rapid turnaround of digesting and absorbing data and integrating it into your business practice. And I'd say that for us would be our biggest challenge. It's how do we get that data quickly, ingest it, test it, and learn from it in a meaningful way that we can now roll it out to the rest of our business. I'd say, as a market participant, we would like to do that better, faster, cheaper. And I don't think that's going to change a year from now or 2 years from now. I just think the need for us to get better, faster, cheaper, quicker is accelerating. Because the market is more competitive. And as I think Rosa mentioned earlier, the customer is going to demand it of it anyway. Mm-hmm. So if you don't get out in front of it, you're likely going to be left behind when it comes by.
And you mentioned if the consumer was actually willing to give access to that data, then we'll be able to analyze it. So my question is, right now, during your underwriting, are there specific access to information that you asked that you didn't ask, let's say 2 years ago? I don't know. I'm really just imagining here, like access to your non-traditional, very access to Facebook or whatever it is. Is it something that you ask now in your underwriting process that would have been considered odd 2 years ago, but now it's more, you feel like consumers are more, have the appetite for it, and they actually they say, yes, I can give you a better rate if I have access to this type of data. Would you consent? Yes or no? So is this something that you've done?
Well, in our case, I'd say yes. I think Tyler and Ilya can certainly comment, but ask me 10 years ago if customers would have been willing to give you access to their bank accounts. No way. Mm-hmm. No way. You can't touch that. That's mine. It's got a whole bunch of business in there I don't want. Oh, but if that information gives me a greater likelihood of securing credit with you, and maybe credit at a lower rate or credit for a larger amount or on better terms, am I going to give it to you now? Yeah, I think I just might, because if I really need that credit, all of a sudden the game has changed and I'm giving to get. Mm-hmm. Whereas I think back, again, the gray hair, 10, 15 years ago, I don't think customers would even think to give that over. A, because there was no mechanism to give it over. And B, the notion of what was in it for me really wasn't evident, I think, at that point. So I think the dynamic of the consumer has changed all that. The key now is to get that information, not through 50 different consents, but through one consent and one seamless interaction transaction where, they're not giving you their bank account, their hydro bill, their brother's last operational details. Like, they're not going to give you all that information at once. You're going to have to create mechanisms to get it where you make it less friction for the customer. And I think that's where the finer nuance comes in for the future, because I don't think there's one organization that's excelled at that completely. I think there's lots that have done pieces of it, and we'd be one of them, but there's still a lot more work to be done in that area. It's still, in my view, still early days.
I agree.
Yeah, I agree 100%. I think, these innovations are here to stay. And it comes over from the commercial lending side, right? In commercial lending, if you lend to a corporation, they'll always give you access to the financial statements, to the bank accounts, everything else, right? So for us in the consumer space to adopt this is just natural. And I agree with Jason, the consumer is willing to give this up because they know they can get better terms if they do. There's a lot of talk about, and we've got large partners in the States. I think the States are about 5 years ahead of us in terms of rolling out these technologies. There's a lot of talk about using open source data. So social media is one that you mentioned, Amir, to score consumers. Again, I can't say that I've seen this successfully done, but certainly, I can see that as being part of the underwriting going forward in the future, and I can see how it could evolve or influence underwriting decisions. So there's a lot more that is to come that we'll be able to use to score consumers to, find the right fit for our businesses. I think, where we have to be a bit careful is because there are regulations around this, right? So privacy and all the other regulations that are on the CPA, but also in various different bodies of law that we have to follow are very important, because we don't want a big brother state. We don't want to do something that would be offside, from a regulation perspective. So that's one thing to keep in mind. But as long as we've got proper consents and the consumers are willing to give us this information, absolutely.
Very interesting. And now that we're talking about, consumers, their appetite to give access to data and possibly get better rate based on that generosity, how do you see auto finance changing for consumers specifically in the near future? Not just the credit score, the rating, but it could be the end-to-end experience. How do you see that happening?
I think the biggest difference between auto lending and a lot of the other lending areas is the asset. It's the vehicle, right? So when you look at our business, the asset does still come from the dealer, and a lot of the decision making in the process of getting an auto loan is depending on the dealer. Just the fact, and I think Rosa spoke about this, just the fact that it's the dealer that presents the various approvals to the customer. It's the dealer that is basically in charge of this whole process. The issue with that, and I don't mean this in a negative way, but it's just reality, is that the dealer has an agenda. The dealer is out there to make profit for the dealer. And that's normal course. That's just the way it can be any other way. However, that does present a challenge for the consumer, because the vast majority of consumers don't do a lot of their own research, don't really understand all of their options in terms of getting that loan. And so this is where auto finance, I think, will be likely the slowest to evolve, because you still have that dealer who's in between you and the consumer. Models like the one Tyler is talking about change some of that, and it really depends on the execution, depends on how they're being rolled out. But ultimately, as long as we can provide all the information to the consumer, they can make better decisions, for sure.
Yeah, that's kind of where we come into play, because we actually show the dealership at this point every lender that would approve that customer. And I mean, I look, working in a dealership, I know how that is too. I would hope that the F&I manager would turn the screen and say, here we are, let's talk about it. Because I mean, I think we talked about it not that long ago. It's not always about interest rate. Interest rate is not what's going to get you the best deal. There's so many other criteria involved in what is going to be the best for that customer. So I think that it is definitely going to be in stages. I think a big reason why we have created Lucy as this decisioning platform that matches consumers to all these different lenders and has that transparency is because we're already trying to lead that way into the industry, starting with dealers and then eventually hopefully working with consumers, so that there is, the word again, transparency. I think that will help change how the automotive industry is looked at in general. We got to change that narrative as well. But I definitely agree with Ilya there that we have to start showing customers their options. It's important. They need to know that. And I personally would not get a mortgage without knowing all of my options. I'm not just going to agree with my mortgage broker. And I think I had this conversation with someone else the other day, and they're just like, well, what's the difference between the dealership and going to the bank? And I only have one touch point at the bank. That's it. That's who I go to at all the time. If I need my mortgage, if I need to talk to them, if I have the insurance issues, whatever, one person. When I'm financing my vehicle, I am going to a salesperson, a receptionist, a sales manager, a delivery specialist. Then I'm going to an F&I manager. Then from the F&I manager, it goes to a bank, and the F&I manager doesn't control the bank's process. So you then get transferred back to a bank. So it's very long, it's very draining, and it's not always the best experience. So we have to find a way to really merge some of these things together. And again, I go back to showing transparency to the customer, and I'm going to leave it at that.
That was good. You're absolutely right. Anything else to add?
I think the transparency has been said a lot. We think about kind of 4 pillars of the retail and the auto finance transaction, and transparency is one of them. Convenience, I mean, I think it's been mentioned, but like, spending 5-6 hours at the dealership is just completely unnecessary. And like Rosa said, you have 5 or 6 checkpoints, right? You're at the lot, you're finance manager, receptionist, waiting room, all sorts of different pieces that, I think the online model that we have allow us to eliminate. And it's not necessarily, the online model doesn't fix all of these things. It just provides a new platform to be able to do some things a little bit differently. And then, the savings side, which I would say is the 3rd pillar, with less dealer overhead, obviously no commission salespeople, which solves a number of problems. And then insurances, and assurances I would define as, a return policy, which is what we have. You can buy a car, you can return it if you don't even, for whatever reason you want, you didn't like the shade of blue it was, it's fine. And again, that could be done at a dealership level as well. It just becomes a lot more complicated when there's a salesperson involved who's been paid a commission, who definitely doesn't want this to be unwound at that point. So I think just, if we're thinking about auto finance in the future, it's those 4 things I think stand out to me as key.
Awesome. And there's 2 last questions before time is passing fast. It's 4:20. There's 2 questions that came up, and I personally like that question because in my banking days, this was a hot topic. How are you handling fraud? What are the measures? I mean, we're talking about consumer habits, access to more data, appetite to give consent. What are you doing in terms of fraud? Are there any concerns that you have? 1, and 2, what are the measures you're putting in place to handle that? And it doesn't have to be everyone, but if you have any comment on that, I'd love to hear it. And then we'll finalize with the last question for everyone.
Yeah, I mean, what I would say to this is there's a ton of technology tools that have hit the market in the last couple of years to handle fraud. And one of the best sales presentations I've ever been in was when Equifax was in here presenting their fraud tool. And they actually showed us how synthetic fraud is perpetrated. Oh my God, eye-opening experience, I can tell you. So, I mean, they have a tool called Citadel that we use internally. There's others that are out there that we use as well. I think it's a very important topic with technology just in general evolving and people getting better at it. Fraud comes with it, and that's just kind of normal course. So being able to recognize it, being able to get to that fraud early is key. Ultimately, in your audit and funding process, when we fund loans, there is no substitute for actual work. When you compare signatures, when you look at the picture on the driver's license, so on and so forth. But a lot of that can be stopped by just using the right technology tools. I think in Canada, we do a fairly good job aggregating data so that institutions can share data with each other on people that they've flagged as somebody who perpetrates fraud, and as long as obviously within the legal framework, but that data can be shared, and we can make sure that we get or the databases are being well maintained. I think it's a great way to combat fraud.
Gotcha. I remember back when I was working at a financial institutions, they considered ink signature more fraud preventive than electronic signature. And I'm sure, Jason, you went through that too, that mindset of what, electronic signature, but think of the possibilities of fraud. And I can only say, well, I can just give me a pen and I will fraud any signature that exists, right? So ink signature, that was good times. And I will finish with this one. I'd like to have your opinion, all 4 of you, on this one. Is what are the disruptions that you see that will potentially affect the auto finance experience in Canada? And this disruption can be via software, can be via logistics, can be via any type of innovation. I'd love to hear, like, how do you see technology change, well, disruption changing it in the future? Tyler?
Thank you.
Sure. Sure.
So as an inside joke for the attendees, it's just, I was gonna point always to Rosa, but I promised I wasn't gonna do it. So Tyler, it is.
Look, I think the industry is ripe for disruption. I hope that we are a disruptor in the industry, and we're constantly thinking about how to disrupt our own business and continue to push forward. But look, we have an industry that is highly dependent on dealerships. That's an institution that's been around for a very long time. Lenders are bidding for business primarily through DealerTrack. Again, in an auction system, I think there's lots of pieces here that are ripe for disruption. I don't know exactly how it's all going to happen, and I'm sure we'll see a lot of it unfold in time. But I do think it's an exciting time. I think, like, even if you look at what Tesla's doing, they're as far as not talking about the technology of their cars, but just how they're retailing vehicles. I think that they're the biggest, newest manufacturer that's really made a dent in North America, right? And so that's very interesting. So I think that there's going to be a lot of disruption. I hope that we're participating well, and I think bringing a market to e-commerce in Canada, I feel like the results are going to be great, but there's lots of areas.
I can pick up from there.
Sure.
Thanks for
Rosa, your turn.
I would say that disruption has already started. I think everyone has seen it with dealerships learning to operate so thin. I mean, they may never go back to the way they used to, and having everything, be as walk-ins. They might just go back to sticking, or I'm sorry, they might just stick to digital solutions and booking appointments and selling online and then doing the delivery. We don't know, but this is a start, and I believe very strongly that this was the beginning. We all know we're going full electric soon. It's, we might be 10, 15 years, 20 years from now, but it's going to happen. And by the time we blink our eyes and it's like, wow, it's here. That's going to change this industry a lot. People will not need to come into a dealership as much because, first of all, services are going to be over the air. You're going to come in for very basic things like your tires and your door handles, things like that. So digital retailing is going to be the biggest, I believe, disruptor in the automotive business. And I think I go back to the word that I'm going to keep saying because I believe in it strongly. It's transparency. We need customers to be in control of the second, sometimes first, biggest purchase in their life. And that's really going to change how I think the industry is going to go. So there we are.
Gotcha. Jason?
Yeah, I mean, I can just add.
Ilya?
Go ahead, Elliot. Go ahead.
Yeah, so Jason. No, what I would add is that I think we already see some of it play out right in front of our eyes. I mean, I'll give you very simple examples. The De Rosier report shows that cars are on the road a lot longer today than they were 10 years ago. So from a lending perspective, obviously that plays into amortization schedules, into terms and everything else. Another example is, depending on where people live and work, there are various delinquency rates associated with the area, and you can actually see that, right? So there's things that I think you just have to be open to. You have to constantly analyze the data, your own portfolio and alternative data, if you can get your hands on it, and see how it affects your business now and in the future. Ultimately, all these trends, some of them are being hyped up in the media and people talk about them, and some of them are just kind of creep up on us, and suddenly you realize, oh, well, this has changed. And so it's like a living organism. It's constantly evolving. You just have to be open to it and adopt to what's coming.
Yeah, I'd say two trends. One near term, and it kind of builds on what the other panelists have said, and that is, I do think the customer is going to come first, and that's going to transform the buying experience. I mean, Tyler's already spoken to how his organization has really leveraged a model, if you will, that's proven to be interesting and building in the United States around, putting the customer buying experience online and seeing it through end to end. So I think that's a change. I think dealerships are going to be they're going to be forced to do business different, because I think if we believe that a consumer first lending model, and I'm using those terms specifically, is coming, where the dealership distribution becomes secondary and now becomes a lot more commoditized beyond what it already is today, then I think that's going to transform the landscape. So I see that short term. The long term one really gets my noodle baked for you Matrix fans out there, and that is I don't foresee a world too far off in the future where people own cars anymore. Why do you need to own a car? If the cost of car ownership can be dramatically reduced by the likes of Teslas and Apples and Googles, who are going to build autonomous self-driving vehicles at a fraction of the cost of ownership, then why do people really need to finance cars? The only people who are going to need to finance cars are people who are going to want to drive them. So that's upper crust. I don't think you're going to find a lot of non-prime customers willing to go out there and finance a car if they can actually borrow one at a much cheaper rate. So that means, what does car financing actually look like? Are you now financing private companies or private individuals who own fleets, who rent their cars out or loan them out? Because they don't have to drive them if they can drive themselves. So I wonder what a world looks like where we don't have traditional car buying, period. In fact, I don't think you have a world where you have people buying cars all that much anymore. You have them buying something, and it might be a share of ownership of a vehicle, because I think the notion of what cars mean and represent might change. Now, I'm not suggesting that's here tomorrow or even 2 to 3 years from now, but I do believe, aside from the growth in electric vehicles, which I think will be far more prevalent in the next 2 years when their cost of ownership eclipses that of traditional gas-powered cars. But the real one that I'm interested to think about is what happens when people realize that they really don't need to own a car. And the only reason you really need to own a car is because you like the sound of the engine, not because you need to get from point A to point B. And what does that mean for car financing? What are we now financing? Charging stations, ownership vehicle rights, parking garages? What are we really financing as an industry? And that has my head spinning a little bit. And thankfully, we have a few years to figure that out. But that is likely going to be coming in some way, shape, or form. So those are two trends I see in the future.
So basically, you're saying that we're not going to be hosting this panel in 5 years. Is that what's happening?
No, it'll just be a different panel. It'll be a different kind of panel.
We'll call it differently.
We'll call it something else.
Yeah.
Don't let me know.
Danielle, it's all yours now. Sorry, I spoke too much.
No, I'm sorry to cut it off. I feel like we could go on, and hopefully we'll be able to do a part 2, and then in 5 years revisit this and see where we're at. But I really wanted to thank you all for your incredible insight, and to Amir for moderating this great session, and to thank to everyone who tuned in and submitted questions. Thank you for joining us today. We invite everyone to become a member of the CLA and participate in the FinTech lending community, and of course to continue attending our upcoming events. You can find them at lendersevents.com. So thank you again for joining us today, and I hope you all have a great rest of your day.
Awesome.
Thanks everybody.
Thanks,
Have
everybody.
a great day.